Soft labor signals sticky inflation and cautious Fed reshaped expectations for interest rates this week. And because of the federal shutdown, the unemployment rate wasn't released on Friday, October 3rd, leaving investors and the Fed flying with less visibility. Uncertainty that itself moved mortgage rates and the housing markets. Let's start this week with mortgage rates. According to Mortgage News Daily, the 30-year fixed mortgage rate started at 6.38% and ended at 6.36%. For investors, DSCR loans usually price about 1% higher, leaving most rental property loan quotes in the mid to high sevens. That is slightly easing in rates is modest, but as we will see, even small changes can ripple through the housing market and real estate investing decisions. On Monday, September 29, pending home sales rose 4% month over month and 3.8% year over year, proving that buyers are responding to lower rates. It was a strong sign of resilience in the housing market and a reminder of how closely affordability is tied to interest rate move. By Wednesday, October 1st, labor data signaled further cooling. ADP private payrolls came in at 54,000 jobs, while jobless claims rose to 227,000. A softer job market tends to support lower mortgage rates, which in turn helps investors and buyers in the housing market by improving access to financing. Then on Thursday, October 2nd, inflation data kept pressure on the Fed. The core PCE index rose 0.3% MOM and 2.8% year over year, while headlines CPI held at 3.2%. That is still above the Fed's 2% goal, meaning cuts will be very slow but steady. Inflation also supports rental income growth, a positive for DSCR loan investors. Finally, on Friday, October 3rd, the BLS jobs report showed only 22,000 payroll gains, but no unemployment rate due to the shutdown. With incomplete data, markets stayed cautious, limiting how much mortgage rates could fall. A clear reminder of how politics and policy directly affect the housing market. If you're closing soon, lock with a float down option. For longer horizons, floating cautiously may work, but watch October CPI. For DSCR investors, stronger down payments, negotiating seller's credit, or using creative financing like seller's carryback or interest-only loans can keep cash flow strong in today's housing market. Even modest dips in mortgage rates can reignite housing activity, as spending sales showed. For investors, structuring deals wisely now means you will be positioned ahead of the next wave in real estate. So this week's mix of weak jobs, sticky inflation, and missing data kept DSCR loans in the high sevens, underscoring that success in today's housing market comes from smart deal structuring, cash flow discipline, and creative financial strategies. That wraps up this week's housing market update. But right now, the government shutdown is already underway and investors are everywhere, are asking if this could trigger a housing market crash in 2025. In my next video, Government Shutdown 2025, Housing Market Crash, do this instead, I will show you exactly what this shutdown means for rates, home prices, and your investments, plus the moves you should be making today to stay ahead. Click here to watch Government Shutdown 2025 Housing Market Crash. Do this instead now, because waiting could cost you. And just like this, these are already obvious. Thanks for watching. If you found this video helpful, give it a like and subscribe for more expert insights on real estate investing. If you're ready to take the next step or have questions, call or text me at 914-334-0920. I'm here to help you understand the market, find smart loan options, and turn today's challenges into tomorrow's cash flow.